Hey guys and gals, Kevin Bupp here. I've got some very exciting news I'd like to share with you before we jump into today's show. Now, after closing on Fund 4's first acquisition of a $50 million institutional grade mobile home park, we're adding a second irreplaceable piece of real estate to the portfolio, and it's coming into the fund with over $1.5 million of built in equity for our investors day one. Now, when I say irreplaceable, I really do mean it. I mean, this is an affordable yet high-end waterfront mobile home park located in the Columbus, Ohio market. Quite literally, every single mobile home on this property is right on the lake, each with its very own personal boat dock, meaning a very high demand for affordable weekend getaway options, as well as year-round housing for working Americans. This is a true unicorn of a property, and you will not see another one like this come around again. It really is a one of a kind. A few other aspects worth noting. This park is producing stable and predictable cash flow day one. We're acquiring it with an excellent in-place Freddie Mac loan at a 3.3% interest rate for the next 8.5 years. This also includes a period of interest-only payments. Again, the simple supply and demand dynamics here are enough to get excited about. This is affordable lakefront real estate for both the working American families as well as folks looking to lock down a reasonably priced waterfront escape. Don't let this opportunity pass you by. Visit investwithsunrise.com to register for our webinar and learn about all the wonderful aspects of this property going into Fund 4. Again, that's investwithsunrise.com. Now, let's get on to the show. Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate investment expert Michael Salafia. Now, Michael is the managing partner of Miami-based STAX Real Estate and CEO of Miami-based Re-Up. STAX Real Estate is an industry-leading platform for the sale-leaseback of net lease retail properties. Re-Up is a gas station and convenience store retail operator focused on elevating the customer experience through the integration of AI-powered technology and design. Now, Re-Up is elevating the way people refuel, recharge, refill, re-up, entering a pent-up demand for a modern, clean, and healthy convenience store experience. Now, Re-Up has 9 stores open and more than 30 in the pipeline, strategically positioned for accessibility and convenience across Florida, Mississippi, and Louisiana. And so with that, guys, it's an honor to welcome my guest for today's show, Michael Salafia. Michael, how you doing today?
Kevin, we're doing great down here in sunny Miami Beach, Florida. Thanks so much for having me on.
Yeah, excited to have you here. Excited to learn a lot more about both of your concepts. It seems like there's a pretty neat synergy between the two, but I'm gonna not necessarily guess as to exactly what it is you do in each one of those concepts. So maybe, first and foremost, Michael, for those that are tuning in that aren't familiar with you, your background, what it is you do, maybe tell us a little bit more about yourself. Fill in some of the blanks there about maybe even back up a little bit, before STAX and Re-Up, and then we can kind of work our way into what those two concepts are.
Right, absolutely. So, at STAX, that speaks to the background that I come from. I come from a background in commercial real estate investment, management, and brokerage. And prior to starting STAX, I was actually a leading broker at Marcus and Millichap. And I've got very good at acquiring these type of properties that were maybe in a little bit of distress and then fixing them up, renovating them, stabilizing them with a new tenant, putting in a new tenant, getting a new lease with extended term and better credit, and then taking this project, this property, and reselling it as a triple net lease investment property. So that's where I really started honing in on that process, doing it as an advisor for my clients. And I was so successful doing it for my clients, they invited to just have me come and manage my own shop with my own team independently. And that's how we started STAX as a sale leaseback company instead of just a traditional investment sales brokerage. We go into much more detail and we're much more involved throughout the development life cycle of the property.
Is there a particular asset class that you specialized in? I mean, was it predominantly retail, like single tenant retail?
Retail, yes.
Okay. Single
Very
tenant retail,
focused
or?
in single tenant retail.
Okay.
Yes, that's the background it came from. And even prior to getting into the brokerage market, I did a lot of consulting projects for REITs and investment banks that held large single tenant retail portfolios. So I was exposed to the industry, say, from the top down.
Okay. I want to paint the baseline picture here, and so just to get a better understanding of the life prior to Stacks at Marks and Millichap, when you mentioned that you basically would find an opportunity that was somewhat broken value add, retenant it with
Right.
better credit, and then ultimately, sell it as a triple net opportunity. And so, give us, what would that typical deal look like? It was just was it a vacant retail building, 5,000 square feet, 10,000 square feet? I mean, what was the normal profile
No,
of?
no, take like a KFC that
Okay,
is on a good national retail corridor, but for whatever reason, that store isn't performing. Maybe there's a year left on the lease and the operator hasn't exercised an option. Well, at that point, you can tell it looks like maybe he's going to pack up and go home. The question is
got it.
why, right? And if the real estate fundamentals are there to support the business, it might be a matter of the operator. Now, that is a key part of our thesis that we look for when we're examining properties, right?
Hmm.
And when we find these opportunities where we have good real estate but bad operator, that's where we have opportunities to add value.
And how can you get that the additional detail necessary to make that determination of it's a good operator or a bad operator, right? Like the real estate fundamentals are there, but just as the example you just used, like the KFC, good location, maybe 1 year remaining on the lease term, but you've identified it as a struggling operator for XYZ reasons. But how do you get that
Mm-hmm.
additional context necessary to make that evaluation?
Always through industry expertise, right?
Okay.
So I personally carry my own set of industry expertise for the gas station and convenience store space.
Hmm.
For doing the fast food restaurant, we would look at other expert consultants that we have. Most of them, like the typical profile would be, I'm the CEO of a small of a franchise company. We have 50 KFC and Pizza Hut franchises, right? So
Hmm.
now I loop him in and use their team as consultants to help
Got it.
advise on business side. But for us at Stacks, that's part of our core competency is also being able to underwrite business valuations. As you know, in the state of Florida, if you're a licensed broker, then you can not only broker real estate, you have a license to broker
Hmm.
businesses. So understanding how to underwrite these businesses within a specific niche is really important. That's why we really focus on our categories that we understand intimately. And when you go into single tenant, now it gets a little bit easier to break this down and understand the mechanics because you have one building with one tenant running one business. And typically there's, one income stream. In convenience stores, it gets a little bit complicated. There's a lot more than one income stream.
Sure.
But still,
For sure.
you build your model and then you work off those models.
Got it.
So in our shop, we've built several quant models for going through and understanding these businesses based on the data that we have available, whether it's comparable sales performance from other similar stores with similar real estate characteristics. And then we also have our qualitative models to understand from a human perspective, maybe what went wrong at that store. Really easy thing that you can do on your own is read the reviews on Google before you invest in a
Sure.
property.
Yeah.
It's funny, but if you're going to go out and say, "Oh, I'm going to buy this Wendy's triple net lease property from this big franchise operator, and they have a great guarantee and they're doing well," before you buy it, maybe read the reviews and see what the actual customers are saying. Because some of the reviews are great and you'll be getting a good store, but some you might pick up like, "Hey, they're having a problem with the manager there."
Do just curious. I've always been of the mind that if you've got a bad experience, typically that's the only time that you really take the time out of your day, whether it be a few minutes, what have you, to actually write a review, go through the process of writing a review. But um, does that? I mean, does that weigh true for someone that's had a positive experience? Have you found? I mean, like the equal proportionate share of positive experiences will do the same thing and write a positive review. So anyway, I've always had this
No,
skewed viewpoint of reviews, but for the most part, though, I would say that if
you
you've
have to
got
keep
something that's
that in
got
mind, though.
hundreds or thousands of negative reviews, there's a really good chance it's probably there's something wrong there, right? So I do agree with that.
Don't worry about the star rating. Read what people are saying and you look
Yeah.
for the specific comments. So for
Okay. Fair
example, if
enough.
I have over the past year people consistently saying, "Oh, they're giving me a bad attitude," or "Oh, the bathroom is always dirty," I know that this
Yeah.
manager does not know how to run a checklist. So if the
Yeah.
manager can't run a checklist, then there's no way that store is running at its full potential. And then we can look deeper under the hood to see what else is going wrong in that store. So it's about having like indicators and red flags. It's not necessarily something to trade on, but it's something
Understood.
to get you looking in that direction.
Understood. Sorry, I kind of took us down a rabbit hole. Didn't mean to do that. And so
That's
let's bring it
okay.
let's
It's
bring it back
important
to
to
the top.
clarify.
uh, so let's start with the basis of the stacks. Again, we're talking about sale leaseback, but again, for those that might just not know entirely what a sale leaseback is, maybe in a simple sense, let's give the definition of what your business model is at Stacks, what you specialize in.
Well, just to define a sale leaseback would be if, take a really easy example. CVS buys a building and makes a CVS, and say they actually do it on their own for some reason. Well, CVS is not in the business of commercial real estate investment. They're in the business of operating retail. So once they have so much real estate on their balance sheet, every so often, they'll sell the real estate and lease it back to themselves. That's called a sale leaseback, right? So what we do at Stacks is at a smaller level. We'll go and buy a property. So say it's a gas station and convenience store, and say that store makes $100 a day. Okay, so it's not doing very well. So we'll go in, we'll buy the store, we'll remove whoever the current tenant is, renovate the store, bring in a new tenant that has a better business model and a better credit rating and is better at managing the store. And then once we sign the lease with that tenant and the property's been stabilized, we can exit on our deal. So then we can sell the real estate to an investor. And now we've sold it we took a property that wasn't doing well and couldn't really afford to pay the rent. They didn't have transparency into their accounting for their underlying business. And we created a property that is performing well. It does have the ability to pay rent, and it is producing financial statements that prove that it's doing enough in sales to support the income required for the business. We really think just like a bank and do it in reverse. So we need to make these products very safe, right? And follow like whatever the standards are that banks have. We need to rebuild this product so it can meet those standards, right?
Is that where re-up? I mean, where does re-up come into play into the strategy?
So re-up came into play because we did so many of these gas station sale leaseback deals. Our landlords started coming back to us and say, hey, you guys are so good at doing the advisorship. Can you just step in and be the corporate managers for these assets for us? We said, well, that's a lot of work. But for my partner and I was already in the process of buying one of these stores for myself. And he had half a dozen of them as well. So we joined forces. We've been working together for about a year and a half. And we opened up our own chain of stores, our own brand called Re-Up. So we're not only doing re-up sale leasebacks at Stacks. In fact, that makes up a small portion of our business overall because it's a new company, it's a startup. But it is another company that Stacks supports for real estate acquisitions, and it has run the sale leaseback process for re-up as well. So the two fit really well, but re-up is just a client of Stacks at this point. So it's very good synergy.
Got it. Got it. And we've all, if everyone listening here drives some type of vehicle, or they have historically driven a vehicle, that we've all had a bad experience, right? At a gas station / convenience store, gross pumps, trash all over the place, oil stains everywhere, inside, just, things are in disarray. The bathroom's disgusting, right? Like it's just, you check all the boxes on the list, like just not a great experience. So re-up, what is it that you guys are doing to redefine that more common than not experience that we have in a lot of gas stations? Now that surely there's operators that do a great job, right? Like on a large scale,
Yeah.
Buc-ee's, right?
Right.
For those that have been through a Buc-ee's, they kind of pride themselves on the cleanest bathrooms, right, of any gas station
Right.
that you go to, right, amongst many other things. But would love to understand the
So
concept that you guys have
first
there at
thing,
re-up.
yeah, and there's different ways, there's different perspectives that we can look at this through, right? From the management perspective, from the customer experience perspective. But when we're, every time we buy a store or take over a store, we immediately gut the bathroom and remodel the bathroom. is the first thing every time. So we always have clean bathrooms, right? Number one. Our vision with Re-Up is to create a more modern convenience store experience. Okay. Right now, the market's become very fragmented. All of the new gas stations and convenience stores that are being built are more of these large format stores, right? You describe Buc-ee's, that's the size of a Walmart. It's a
Yeah.
huge gas station. So it's very cool, but is it very convenient? I don't know. Just based on the size, no. The answer is simply no. It's not a corner store anymore. At Re-Up, we do actual like convenience stores. Your small format neighborhood corner store, or that store that's on a busy road where you're actually driving near your office, right? That's really what we're focused on for the most part. So a lot of these stores, in fact, the majority of them in the market are actually independently owned and operated. And this
Hmm.
is across the United States of America, right? And at many of these independently owned and operated stores, they just, it's a small business, and a lot of them run into challenges. And a lot of the folks who bought these stores maybe 10 years ago are at retirement age, and they're maybe new Americans, and now their kids went to college and became doctors and lawyers, and they don't want to take over mom and dad's convenience store.
Yeah.
But mom and dad have been working really hard for the past 20 years, and now times
Hmm.
have changed. And like you said, managing those checklists. So they're still there with the clipboard trying to figure everything out. You know, and look, we're helping people kind of exit out of that. And we've been taking over a lot of stores where they just became neglected and the management isn't there. And we come in with a modern management program. Our staff walks around with iPads. Everything we do is digitized, everything's scanned. We have our own AI powered software that manages tons of the back end work for operating these stores, like serious stuff. Like, for
Hmm.
example, you're selling lottery tickets. We have the AI software that's matching and counting the lottery as an additional layer of security. It's one of the biggest liabilities that we have, cash management in a convenience store business, cash management for the lottery, right? So we cover that with our AI technology. And at Re-Up, we found this great opportunity for taking these emerging technologies and for us being the team to start applying them inside of the retail environment. And the convenience store gives you a really safe space to do it because you're dealing with a much smaller box, right? Maybe 1,500 square feet to 4,500, 5,000 square foot box. Convenience store is not getting bigger than that, not really getting smaller than that. So now you can start testing these different things. We have a coffee program that we're working on. We partnered with a robotics company. We have a concept for a quick service fried chicken restaurant that's very small, and it goes inside, and it's fully, the entire kitchen is operated by a robotic arm. You still have one
Wow.
human attendant there, but really, really big innovations. We see that in the space. It speaks to my background specifically prior to getting into commercial real estate. Like, for my going back to college years, I did my master's degree in high tech entrepreneurship. I've been involved in multiple startups. I've done Series A, Series B's, exits, the whole deal. So I have a really strong background in technology.
Hmm.
So this to me is this really nice opportunity where we're engaging in commercial real estate development, we're being opportunistic, we're getting deals done, finding and hunting for deals, but we're also taking it to the next level, and we're adding the new tech that's coming into the market. And since we're a smaller team, we can implement it faster than others.
Hmm.
And we have a great team behind us that we built, and everything's going really well. In fact, at this point in time, Re-Up actually has 40 stores. Not all of them are open yet, but by the end of the year, we'll have all 40 open. But we now have like 40. Most of them are just being transitioned, like between the management teams. It's a process, obviously.
And they're all 40 of those, they were existing stores. They're just getting rebranded, right? To the re-up.
Yeah, exactly.
And are they,
Exactly.
is there always gas involved? Always a gas station with a C store, or do you
No,
sometimes do a standalone C store?
yeah. So we're actually in talks now, later this week, based on when this podcast is recording. We're finishing up discussions. We're doing a standalone convenience store in partnership with the city of Miami, and it's fully automated convenience store. Okay. You walk in, take what you want, and leave. The way it works is you tap your credit card and we pre-authorize you before you walk in. The entire ceiling is lined with security cameras that have AI recognition software. We're tracking 98% accuracy rates on checkout. So you just walk around the store, take whatever you want. The cameras can pick up and they match it to the price book that shows like, oh, this is the potato chips and this is how much it costs. There's a little screen as you're walking out the door. You can verify your order, or you can just walk out. Either way, it charges your credit card.
Interesting. And so, what does that 2% actually amount to? Is that 2% like of overall revenue that gets lost is due to inaccuracy of the software? Or?
No, it just that's like the inaccuracy of the ticket. So most of
Okay,
it wouldn't actually be a loss. Usually at the checkout ticket at the end, somebody would say, "Oh, that's not correct," and they would just adjust their order.
understood. Understood. Interesting. That's really cool. So, I mean, what does that footprint look like of that new concept? I mean, how large is that concept?
It's small. It's a 1,500 square foot box
Okay.
about, um, and it's going to be very interesting. So the first ones going in, we're looking at putting these in areas where it's challenging to fit a full convenience store, right? You have a lot of people, high demand for a bottle of water. Let's just focus on the bottle of water,
Mhm.
right? And you have 100,000 people walking through here every day. Think about the middle of Times Square, right? Like something like that. It can fit in these kind of places. So we're doing it at a Miami has what's called a like a monorail.
Mhm.
We're doing at one of the monorail stations called the Underline.
Yeah, no, that's fantastic. I mean, it's just basically we think it was like an oversized vending machine to a certain degree, right? It just has more options,
Yeah,
many more options available, but just as convenient.
many more options available. I mean, I would
Yeah.
love to just put these up and down the East Coast of the United States at every single beach. And we can put solar panels on top, a battery pack on the side of it, and have it like very sustainable, eco-friendly, on-demand convenience
Are you able to
in
sell that
hard to reach
in
places.
in that type of concept? Are you able to sell alcohol beverages and nicotine or no?
Well, it's on a county by county, city by city
Okay.
basis. So our technology partner does have like the tech and the protocols, but it's sensitive, and the last thing we want to do is have any kind of issues. So until everybody at the city and state and county level is understanding that, look, putting your ID up to the AI with your face there is just as good as a human checking the ID, and also we scan it, right? And there's control over like actually pulling that product out. We have to make it so somebody couldn't go in, scan their ID, and then somebody else comes in and takes it, that
Right.
kind of thing. Police it a little bit, but we just want to make sure there's no issues ever. So we'd like to get there, but the business model does not depend on being there.
Yeah. Well, that's exciting. Yeah, congrats. That
Yeah.
sounds like a fun project, and one that ultimately it's going to have just a huge demand for its use. So,
Yeah.
we'd love to circle back here. I know that we're kind of bouncing over all over the place a little bit. Maybe before we
Sure.
move on, and this could be just a general a question across the board, whether it be based on re-up and your expansion plans, whether it be just opportunities in the sale leaseback space with stacks, but just the debt markets. What's going on with the volatility in the capital markets. Just what type of impact have you guys seen? Any major pivotal moves that you've made within the organization as a result of just the uncertainty that exists there?
I think the uncertainty that exists even drove me into gas stations to begin with. As other properties stopped selling as frequently, these properties were still selling. And when recessions happened and when COVID happened, these properties remained stable.
Hmm.
So they've been performing well throughout the tough economic conditions. The high interest rates have taken a lot of yield out of the market. So it's much harder to get a deal done. There's less juice to squeeze. We have to be very tight on our numbers, very conservative. So I think the debt market, if anything, has just made us really, really disciplined, because
Yeah.
there's no more margin for error, and we have to count. It's actually hard. Like when we're doing these gas station convenience store deals, I have to count down to dollars. Sometimes I have to look at pennies on these charts. mean, when's the last time you looked at a spreadsheet and had to actually consider the penny? Right? Typically, it's insignificant,
Yeah.
and all of a sudden, in this business, it's significant. And there's certain things you get used to doing. Right? You're an investor, so I was like, oh, and then that's going to add an additional $2,000. Yep, blah, blah, blah. We're dealing with a $2.5 million budget. What's 2,000? And all of a sudden, it's so tight out here that $2,000 makes a difference, and we have to get very granular. So that's why we have a very disciplined approach. And a core part of our thesis is very simple: rents always must be paid from the money coming out of the cash register, right? And that's a key to this cash flow investing thing. If you want to be in commercial real estate and really do it for success, and you're in retail, the retail makes money from a cash register. The money has to come from there. Okay. If you're looking at this company and saying, oh, they do this much over here, that much over there, it'll all balance out. You can't do that anymore in this kind of interest rate environment. It's too risky and it probably won't balance out. So don't do that. Make sure, very simple, money to pay rent comes from the cash register. I say this to the highest level of investors every single day because it needs to be instilled into everyone's mind in order for net lease investments to be truly stable.
Yeah. Yeah, no, that's great. I appreciate that. And, just curious because, the fragmentation of that asset class, gas stations and C-stores, this, you
Mm-hmm.
reference a lot of mom and pop owners, lots of, aging owners, again, very similar to,
It,
to a
mm-hmm.
lot of the aspects of what attracted us to manufactured housing many years ago.
Mm-hmm.
Manufactured housing is quickly becoming consolidated, and so just a lot more sophistication has entered our space. But I guess one of the big benefits that existed many years back, and we just don't see it as much anymore. Were the what was the opportunity to get mom and pop sellers to carry financing, right? A lot of them they literally have lived and breathed that asset for many years. It literally is their income, right? It's sent their kids to school.
Right.
They've built a lifestyle around that income, but yet they're also in the trenches running the day to day, and they're looking for a way out of it. And a lot of times wouldn't know what to do with 5, 10, $15 million if it was just dropped on their lap, right? Creates another challenge for them. And so
Right. Right.
structuring quality owner financing terms with the seller was a great option, and it is one that seemingly happened quite often. I'm just curious if that, especially given the higher interest rate environment, probably less buyers in the marketplace trying to buy these mom and pop gas stations and C stores. Is that opportunity prevalent for you? Have you seen that to be something that offers you guys an advantage?
We always are looking for it.
Yeah.
It is not always prevalent. And actually, what we've been faced with, the reality of it is the smaller mom and pop operators want that paycheck and want that cash out really bad. Um, the owners or the sellers who have been more willing to engage are those that have a very high value asset, and they understand, based on the EBITDA of the business, the true value of what they own. And they're also coming to terms that the debt markets are terrible and the interest rates are incredibly high. So if they can step in and at least take a partial position of what the bank would be taking, that might be what gets the deal done, right?
Mm-hmm.
Because the financing is not there most of the time. It's been very, very challenging.
Yeah. Yeah, no, great point. Again, flipping back here, and sorry to bounce all over the place here, and I want to make sure that we've got a couple of things I want to work through before we wrap up here for the day. But back to the sale leaseback strategy. One of the things that's always come to mind, and I personally, I've never been involved in either side of it. I've never owned a
Mm-hmm.
triple net lease property, and I've never been a business owner that's ultimately sold my real estate and then leased it back. And so I do not have personal experience. I understand the concept quite well. But one of the areas that I've always seen as a potential risk is really the more so the risk of obsolescence of the actual building itself, right? Once the lease term runs its course, say the tenant, the business doesn't renew. Ultimately, how do you project, what that future looks like as far as for that building, for that structure, and how do you just how do you quantify that risk?
Am I the landlord in this case or the operator?
The landlord, yes, the land. Sorry, I forgot to add that part of it. The landlord, correct.
Okay. So if
So
I'm the
basically,
landlord,
stuck with an empty building after, call it 10 years, 15 years, whatever it might be. Um, Now what? And I think a lot of this is related to just looking at a lot of the and I know this isn't your business, but Dollar Generals are everywhere across the country, and a lot of times they're in very
Yes.
tertiary markets, right? Where
Yeah.
there's very little underlying land value. The metal building that was erected there is not worth much at all when it's empty. I mean,
No.
literally, it has no value. And so, but those
Yeah.
things seemingly have traded, in the heat of the market for 4.5 and 5 caps. I know that's not the case today. Maybe they trade for 6.5 caps, but they're in tertiary markets that have
Well,
already have a high, a high amount of risk, just given there's no population growth, the economic base isn't
yes.
strong, blah blah blah. Anyway, so I think that's probably where the question's deriving from, things like that.
Right.
And I know that's not what you do,
Right.
but just curious because it's still
No,
one and the
I've
same.
sold many Dollar General properties throughout my career. Okay. And the properties I've sold were all good deals. There are a lot of properties out there that I've advised my clients not to purchase. Okay. Because yeah, it's a great corporate guarantee, but at the end of the day, when that 15-year lease is up, that building was not worth very much. They didn't pay for it. The developer, a third party developer paid for it. The dirt is worth next to nothing. Also, a third party developer paid for that. So they have nothing out of pocket going here, except that third party developer wants to build again to get more fees for developing. So why would they invest more money into upgrading your building in the middle of nowhere? They can probably go down the street and rebuild for less money, right? Potentially, and then have a fully upgraded building. So you have to look at it less of, if you're already looking at this at the end and saying, what am I going to do? It's over. You need to plan for this well in advance and be
Sure.
looking at a 5-year outlay when you're at the last 5 years of your lease. Okay, what is your tenant doing? Do they have any intentions here? And start having the discussion with them about renewing very early. And that comes down to your tolerance for risk
Mm-hmm.
as the investor. For me, I have a higher tolerance, so I'll run people all the way to the last minute, because for me, if the property goes vacant, I own a real estate company and I employ a bunch of real estate agents and brokers. So we'll just go out and lease it to somebody else. But if I have a vacant Dollar General in the middle of nowhere with no population, guess who's going to lease it? Farmer John down the street, maybe, to like store bags of grain.
Yeah.
The property is worthless. So don't buy those assets that don't have real estate value. Net lease is not just, it has a bond like quality, but it's not a bond, because at the end of the day, you still have a piece of real estate attached to it. If you're happy to put say $2 million into a Dollar General, collect 5%, and then at the end of it you're left with the building, maybe it's worth something, maybe it keeps generating cash flow, maybe it doesn't. Okay, great. But you need to look at the actual fundamentals of this. In a lot of the cases, there is no opportunity to redevelop those,
Yep.
or at least into anything significant that could produce or replace that rent, because there's no way to recreate that income stream.
Yep. No, that's great. I appreciate the feedback there. And again, I know we bounce all over the place here, Michael, but just I'm going to pass it back to you. Is there any aspects of stacks or re-up that again, we could probably talk for hours upon
Oh
exactly,
yeah, no, I
so
love
it's,
the questions. I love the
but yeah, but
questions.
I want to make sure that if there's any relevant points that you feel are just important to share here as it relates to either one of those firms, re-up or stacks, please
Well,
please
look,
do.
we're talking to cash flow investors, so I think the key takeaways here are understand the mechanics of how your cash flow works. That's what we're looking at every time we invest in one of these properties and we go into one of these projects. That's the biggest part. Figuring out what we need to do for construction, what the cost of materials are. That's very straightforward, right? But you really need to get down to the nitty gritty, and it's the harder work, and it's going to be tougher analysis. It's going to be harder research and more research, but it is worth it, because that's how you can create and truly understand what you're investing in, even if it is single tenant net lease and no landlord responsibilities. And make it fun for yourself. Learn about the business, learn about the industry, do it on the weekends. It doesn't have to be such a chore as the investor, but don't go into these deals blind without an understanding of how that business actually works and
Yeah.
who's running it.
Yeah, I mean that's a great point, and just speaking to the business side of it, just underwriting the actual business itself. I mean, there's a wide array of industries, right, that you guys have dealt with, and so just trying to to be somewhat the master of all and understand the unique nuances with each one of those respective industries and businesses. I'm assuming it's got to be
Hmm.
pretty difficult, right, in underwriting the credit of it.
Right. And you won't get there fast enough because then you'll just be building models after model every time and not using your same model multiple times and refining your model and making it the best version of itself.
Yeah,
Yeah.
no,
I mean, there's a reason we have so many people working on financial models all the time. And they're just on payroll taking salary, right? But we need that insight. That's what's guiding the investment decisions.
so what's the long-term
So
strategy? Talk to me about stacks and re-up, both of them, 10 years out. What does it look like?
yeah, so Stacks is running really well. I'm at the point now where I'm the managing partner and I have multiple team members, leading like in more leadership roles and managing day-to-day operations. I've been very focused on the re-up concept as it's growing very fast. Our plan with that company is to grow, our goal is to grow to 1,000 stores and go public.
Wow.
We'll be at, we already have 40 secured. We'll have 40 open by the end of the year. We've been very fortunate. We have institutional backing from public companies that are listed on NYSE. And we're just very focused on starting this project and launching it off the ground. Also excited with what we can do on a social impact level, because at ReUp, we do focus on bringing some healthier products into the convenience stores and offering some healthier food options. We have a big culture of integrating with the local community. We try to hire local as much as possible. Anybody locally who's interested in selling a product in our store, we're usually very friendly and reasonable to work with them, and we try to curate a good collection of local food products and other specialty products. So it's really exciting because again, this is a big part of the market in the United States of America. You can drive around. I'm sure everybody listening will say, "Oh yeah, I saw that, that crummy gas station. Why do they have all that stuff everywhere and the junk?" It's in a good location, but that thing's run to the ground. We're taking these and we're making them cool. We're making them safe places you want to go, safe places you can go into with your kids, some healthier product options that you can actually eat that aren't bad for you, and and also just making it a nicer, more convenient experience, clean, modern, healthy, fresh. That's
Mhm.
what we're all about here. So throughout the year, Stacks will release a few sale leaseback opportunities from ReUp. We also represent a number of other gas station and convenience store operators, as well as other retailers. So we'll be continuing to launch our investment sale products throughout the year, like our finished products that we can sell to a triple net lease investor. And also to anybody speaking or anybody listening who's interested in having or learning more about the back end mechanics of how we get all of this done with private equity and how we actually acquire the properties, we're always open to having conversations. We work with a lot of family offices and private equity shops on arranging this kind of financing and real estate investment.
No, that's fantastic, Michael. And so for those that want to learn more, that want to, reach out to you, connect, where's the best place to track you down?
Yeah, the best place would just be shoot me an email. It's all on my website, on our website, staxre.com, staxre.com. Feel free to find me on LinkedIn. I'm on pretty much every social media platform. Very easy to find.
Okay, good deal. And guys, we'll get all those social links down in the show notes as well. And Michael, it's been a pleasure having you. I really enjoyed the conversation today. Wishing you all the best as you guys continue to grow in both in both projects, and excited to maybe hopefully bring you back on like in the next year and see what's new.
Same here, Kevin. I'm excited for the part 2 follow up.
Yeah, yeah, sounds good, my friend. Well, you take care, and guys, that's all we have for this week's show. So until we meet again next week, this is your host Kevin Bupp, wishing you huge success. Take care now.